FOMC hikes rates by 75 basis points as expected. Markets tumble. What happens next? That's coming up on 3 Minutes on Markets and Money. Yesterday pretty much went off as expected, with the Federal Reserve hiking rates by 75 basis points, indicating at least 2 more rate hikes this year of 50 basis points. The kind of shocking news, I should say, more than anything else, came from his presser afterwards, where basically making the point that they are going to hike rates and then stay there through the entirety of 2023. Now, that's obviously best expectations, barring that we don't get into a deep economic recession or have a credit-related event somewhere along the way that causes the Fed to reverse policy, which, by the way, has always been the norm for the Fed. They hike rates, create a problem, and have to cut rates again. So very likely, while markets are expecting a rate cut in 2023, what disappointed the markets yesterday was that may not come. Markets did sell off pretty sharply yesterday. A couple of important things did happen yesterday in the markets. First of all, the markets took out these lows going back to May, and that was kind of that important support level we've been eyeballing the last few days, saying the markets needed to hold that, and that's still the case. If the markets can rally a bit here over the next couple of days, wind up the week back above those previous support levels, that will kind of confirm that support level still intact. However, if the markets don't do that, we're now going to have the risk of retesting these lows going back to July. And again, this isn't the end of the world here. Markets pretty much have just traveled sideways now for the last several months. It's been a real grind on investors. Sentiment getting very negative once again. We're moving back towards more fearful levels in the markets. That previously has been a good setup for a counter trend rally. Markets also very oversold here on the short term, and that very overbought MACD signal that we had back in August has now mostly been worked off here. So again, the market is getting kind of set up here potentially for a rally. But again, that rally likely to be just as disappointing as earlier rallies we've seen this year. Any rally back towards that 50-day moving average, which also the 20-day has now crossed back below the 50-day, putting more downward pressure on stocks as well. But any rally back towards 4,000 on the S&P 500 looks to be a good exit point right now to start raising cash and rebalancing risk. With the Fed being more aggressive about rate hikes moving into the end of the year and already signs of economic weakness, it is likely going to cause lower stock prices as earnings and corporate profit margins get revised much lower as we head into 2023. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll see you tomorrow.